what outperforms the debasing of fiat currencies? Only two things in the world. The two things are cryptocurrency, Bitcoin, Ethereum, and tech stocks, because they are both secular trends in technology. Nothing else outperforms this. What role does gold play in the investment landscape? You see, there was a narrative from the 1970s that has been held on to, particularly by boomer types, which is that you see one day this financial profligacy will create a bull market in gold again. When you look at gold mining stocks since the 80s, they've actually not gone anywhere. When you look at gold, it has risen, but it's not risen with inflation. In fact, in real terms, gold's gone nowhere. In fact, it's probably down. The reality is gold does a certain thing and it does it really well. Gold works really well when you debase a currency. Remember, in the old days, they used to debase gold by clipping the corners off the edge of coins. They don't do that now. What they do is devalue your fiat currency. When you look at a chart, and I've got a global macro investor chart of gold over the last 20 years versus a basket of 27 of the largest currencies in the world, excluding the dollar, gold just kind of ratchets higher, and it ratchets higher every time there's a devaluation of other currencies. It also works okay against the central bank balance sheet. It's not racy, but it kind of does its job. The moment the real rates go negative again, that's destroying your future wealth, gold does pretty well. Now, I don't think gold is the best investment to capture this tail risk. I actually think crypto is much better at doing it. I actually think technology stocks are probably better at doing it. But gold is less volatile, so risk adjusted, it's just fine. Right now, it's just not a good bet. And even though not that many people own it these days, it's not a retail investment vehicle. Sure, in India it is, but even in India, we're seeing the rise of crypto. Here's why. The dollar is in this doom loop where it's a game of musical chairs. The musical chairs here are the US is 25% of world GDP. 87% of world trade is in US dollars. Most international borrowings are in dollars. The eurodollar market is the epicenter of that. The issue is when the Federal Reserve start taking money out of, or liquidity out of the system, it knocks through to this murky world of eurodollars and foreign dollar borrowings. And those weaker borrowers start scrambling for the dollars. And it's a game of musical chairs where somebody gets rug pulled and somebody falls to the floor because there's not enough chairs to go around, not enough dollars. The shortage of dollars is what puts the European banking system under pressure. That becomes an issue because it's driving higher interest rates. Right now, the interest rate market has no buyers. There's no buyers of bonds. I've never seen this before. You see, the issue is traditionally the buyers for foreign central banks, they're out of the market. The Federal Reserve with quantitative easing, they're out of the market. The banks, the biggest buyer of all. Regulatory purposes meant that they can't do it. So cash is piling up in the reserve repo market. So there's trillions sitting in there with nowhere to go, not being put into the system. And the pension system. And the pension system has just taken the biggest loss ever in the 60-40 portfolio. That's the portfolio of equities and bonds, 60% equities, 40% bonds. That was the safest investment style of all, and the entire pensions industry worldwide uses it as its benchmark. We've just had the largest drawdown in the history of that strategy. I left the hedge fund industry back in 2005 because I saw the seeds of its own demise. The game in hedge funds now is not about performance. It's not about the glory days of Soros and Nick Roditi and Stan Druckenmiller and Paul Tudor Jones and Lewis Bacon. It's a game of asset gathering. So you are just a pawn in that machine. Even as a portfolio manager, Alan Howard, who's a friend of mine, even used to trade his managers like his positions. If somebody had a great year, he'd get rid of them, knowing that often you're psychologically affected by a great year. I mean, Alan's a great trader. He knows how to trade people as well. But basically, you're a pawn in the game of assets and not in returns. So sure, you might get a chance to get paid by being a portfolio manager, but it's not a great world. The pain trade, I think, is to sucker everybody in thinking there's a great glory collapse to come. The I told you so moment in earnings are going to get revised lower. Well, all I do know is people are record negative sentiment. They're more negative than I've ever seen, ever in any history. I wrote a big article in Global Macro Investor, my institutional research service about this. They're super negatives. People are super hedged. Put volumes have been incredibly high. So I think the path of pain is to go lower, suck more people into short, and then rip higher. I like Solana. Yes, I understand it keeps breaking. Yes, I also understand that everybody knows that, so there is no informational edge in that whatsoever. And therefore, if it survives breaking, and it's one of the largest crypto protocols, and it has more activity than any other chain outside of Ethereum, then the likelihood that Solana participates well in the next up cycle is very high to me. So I like Solana. It's one for me. October feels like it's a volatile month. It feels like we've got downside, sharp downside to come. Then we get the reversals. Maybe we've broken something bigger. Clearly, we're in inflation right now. You have to be a blind monkey not to realize that. I actually didn't think it would go this high, but I also didn't actually have in my bingo card Russia invading Ukraine. But we get these things wrong. That's the part of markets. My view is that this inflation turns to deflation. I know there's a massive analysis of structural inflation driven by supply issues in the oil markets. We could see that today, this fight that goes on between supply and demand. I know a lot of people think that much of this is stickier. I know a lot of people also just emotionally want to punish the Fed for quantitative easing because they want to prove that it has inflation. Those tend to be the gold types. We told you so. Angry men shaking fist at the sky on the internet. My view is that when you have a year-on-year rate of change of interest rates like this, when you have just the mathematical effects of these numbers for next year, it's bloody hard to have positive inflation. And my guess is it goes negative. And my guess is a recession causes more demand destruction. We will see inflation in the next cycle. We see inflation every cycle. But my bet is it is not as sticky and as high as people expect. People have this 1970s narrative because that's all they know. Generally speaking, I don't think that's going to be the case because we're missing baby boomer demand in the global equation. So you're trying to create a supply-driven inflation shock that lasts, and that generally doesn't tend to last. Will we have a depression? No. Why? Because we have the magic bullet, which is debasement of currency. And guess what? Asset prices go up. So not going to happen. So Metcalfe's law is the number of users of a network and basically the number of interconnections between the network. So you can have a network like Doge, which just has users and no connections, i.e. it's not being used for anything. Or you can have a network like Ethereum, which has a huge amount of two. If Bitcoin is mainly hodlers. So different networks can be different ways. The Holy Grail is both together, both growing. What it means is a network is incredibly valuable if people want to own it and want to use it. When you've got the owning and using numbers growing, then the network is valuable. And that's how Metcalfe's law works. And almost all of the crypto protocols work in exactly the same way. And they're pretty much priced fairly according to Metcalfe's law. You know, you can use estimations of Metcalfe's law, but you generally find that they don't deviate a lot. So even things like XRP, I was like, oh, fucking hell, I hate XRP. Well, it actually works. Bitcoin has less transactions than Ethereum by a massive amount, but the size of the transactions is very big. So that gives you some elements of why Bitcoin is so valuable, because it's a valuable network. It's like, you know, you can sell handbags, or you can sell Louis Vuitton handbags or Chanel handbags. That network is worth more than selling cheap high street handbags at Zara, for example. Listen, motherfucker. It's not the age of free information. You're getting monetized by the advertising agencies. Your information is being sold everywhere online by people in ways that you don't understand. Every time you click online, you're being shown stuff that is actually somebody else inside your head using artificial intelligence. My macroeconomic view for the next 1 to 5 years is I'm going to start 1 year ahead. We are recovering. We are coming out of recession. Asset prices are fine. The world is worried. Do we get inflation back or not? 5 years' time, technology continues its relentless rise. Cryptocurrency continues its relentless rise. The baby boomers are retiring and starting to die. Growth has ratcheted down. GDP growth is a very simple equation. GDP is population growth plus productivity growth. Population growth is shrinking. Immigration is politically unacceptable in an age of not enough jobs because of robots and AI. Productivity is the robots and AI. That's going to be the new demographics, replacing the lost workers. It won't replace them at scale, but eventually we get to the tipping point where it's much cheaper to employ a robot. Look at Amazon. They've employed something like 750,000 new people over the last 4 years. And they've employed 500,000 robots in the last 5 years. So inflation lower, growth, I think, actually, we might change the trend rate of growth at some point in the next 10 years when we're running negative real rates to erode the debt, which is good for asset prices. But also, I think the rise of technology can potentially change the trend rate of growth over time. But what outperforms the debasing of fiat currencies? Only two things in the world. The two things are cryptocurrency, Bitcoin, Ethereum, and tech stocks, because they are both secular trends in technology. Nothing else outperforms the Fed balance sheet. So even real estate, pretty much sideways. So it does its job. You maintain wealth. You do not make wealth. Truth is up early. I scaled into a basket of what I call exponential age technologies. That's everything from robotics to gaming to metaverses to crypto stocks to Internet of Things to semis to all of this stuff that plays this mega trend. I averaged in over June. I kind of got I was actually a bit early. I was about May. So I'm down 15% or so in that basket right now. This is for Global Macro Investor and Macro Insiders. I will probably add to it. I'm waiting for that final signal in the NASDAQ. Final question, proof of work FUD. It does use energy. We can't pretend it doesn't. It also drives people to the cheapest cost of energy, which happens to be geothermal, EV, and all this other stuff, gas flare-offs. So I think net is actually driving the greening of energy. But yes, I mean, people care about this stuff. They really do. I know people dismiss it. It's like, those green nutcases. They really fucking care. Gen Z generation really, really fucking cares about this stuff. And people have paid attention. So whether you care or not, people do care. So it either has to come from renewable sources that are proven, or proof of stake is gonna help. Again, it's not an argument over Bitcoin or whatever. Bitcoin does its thing and it does it perfectly.